Nitin Rakesh is the CEO of Mphasis, who's joining us right now from Bengaluru. Nitin, thanks very much for taking out the time. And this is the very first question that I actually want to pose to you because, the market up until now had started to peter down their expectations from the DXC HP deal that you have and penciled in just a growth of 0 to 2% through to FY22. Now that changes, a lot more with the clarification that you just gave out. So let's talk about that and how that's likely to progress.
Thanks for having me. I think, we gave out the clarification late last evening primarily because we realized that there was some confusion in the analyst community. And of course, that was leading to some concerns on the sustainability of our revenues and our relationship. So I think, firstly, it's a strategic relationship that, goes back many years, has spawned and spanned many corporate, entities and ownerships. So from that perspective, I think it's a fairly, sticky relationship with many of their end customers as well. Having said that, I think the confusion we wanted to clear up was that the 990 is not a cumulative number. It actually, works based on certain annual thresholds, and that's the reason why we wanted to kind of, just release some of that concern and anxiety that had built up over the last, few days.
So, would you be saying that the USD revenue growth estimates of 0 to 2% now stands a bit unfounded, and you'll do much better than that?
Yeah, I think we've been pretty consistent, over the last few quarters. We've had 10 straight quarters of sequential growth, both across the company as well as in that relationship. 24% of our revenues are linked to DXC today, and that has also grown pretty healthily. At the beginning of this financial year, we did call out for a moderation in growth purely based on the business characteristics, concentration issues, and of course the fact that we had 2 very strong years of growth. So from that perspective, we guided that we expect that channel growth to be at market, which basically means mid to high single digits. So based on that guidance, we are pretty much bang in the middle of that range based on the run rate for the current financial year. And what we've been saying over the last, I would say, couple of weeks since this concern bubbled up is that we continue to expect that number to be fairly steady as we see it today.
Okay, got that. Now let's talk about the other bulky portion of your revenue contribution that comes in from direct international. And
Sure.
Particularly want to talk about the direct core business. You've been seeing steady wins coming in there. The TCV of 174 million in terms of the net new deals in direct international in the second quarter takes now your year-to-date tally northwards of $325 million. How's the business shaping up? And how do you expect it to do?
Sure. I think we've actually had a very strong run of growth in the direct business over the last 4 quarters. This was the 4th quarter of 16+% year-over-year growth. And keep in mind, half of our business comes from banking. And I think in an environment where a lot of our peers and the general market has been concerned about the growth in banking, we've actually seen a very strong growth. And that's a testimony to the fact that we've aligned our offerings and our capabilities to where the market needs them to be. And hence, we've seen healthy double-digit growth in our banking business. And of course, we've seen other verticals grow as well around it. We called out for logistics and travel as another area of growth, as well as healthcare. So I think overall, we are very pleased with the strong performance we are seeing in our direct business. The pipelines are very strong. Our client relationships are fairly robust. Good news is the growth is fairly broad-based across multiple client segments. Our large clients continue to grow double digits, and I think we called for a strategic client growth to be in double digits. We've seen very healthy new client wins in the last 4 quarters, especially growing at between 80 to 100% year over year, just in terms of revenue. And also, we continue to see good growth from the Blackstone channel and the relationships that have scaled quite nicely. So I think it's very broad-based. Very, very pleased with the way we've scaled up our business in that segment. Digital risk, which is part of direct international, also is now in an environment where we are seeing some good macro tailwinds. That business was headwinded for about a year and a half to 2 years until about 2 quarters ago. And that continues to kind of give us a lot more confidence that we should be able to sustain the growth in the direct business.
You've seen new client revenue growing by over 80% year on year. Blackstone accounts growing over 50% year on year.
Yeah.
Is that aggressive, or is this rate maintainable? And you will be, targeting similar advancement in new client revenue generation?
Yeah, I think, obviously it's coming off of a small base, so some of that will come into play. But, this is the second very strong year of growth for our Blackstone channel business. So we do think that, there is runway. We are less than 5% of our revenues at a company level from that segment. And we do think that we can actually double this over the next 2 to 3 years. So that gives you an idea of the sustainability of the growth rates there. On the new client wins, I think we had a pretty strong run of new logo acquisitions. Now our effort is to scale them and mine them, is because a number of these actually have very large spends. So while the number of logos may taper down purely based on the fact that we want to be much more selective and we want to focus a lot more on growing the revenues from this segment, we still feel really good about the fact that our pipeline is very strong, and our logo wins have actually been the biggest testimony to the fact that we've created a fairly differentiated and relevant set of service offerings, and our sales engine is really firing well.
Nitin, good morning. Neeraj here. The last time that we spoke in our studios, you spoke about how you've not had to really, but thought of changing the strategy almost inside out or around 360 degrees in order to approach the market with a very new dimension, and that will keep you in good stead for a few years. Now, thus far, the growth is paying testimony to what you had planned. What do you anticipate not just the next 2 quarters to be like, because your con call transcript gave that away. You're very confident about FY20. What happens post that?
Thanks, Neeraj. I think you actually, understood it quite nicely. We created a whole strategic framework around what we call front-to-back transformation, where we enabled a number of our enterprise clients in applying the transformation that their clients expect them, their end customers expect them to do. And in many cases, it boils down to really, 1 or 2 or 3 of the following. Firstly, the enterprises need to get a lot more customer-centric, which means that the investment required in understanding who their customer is, what their needs are, and getting to a point where they can predict some of those needs is probably a pretty big, area of focus for almost every large enterprise. Whether it's through personalization, use of data and analytics, or just use of customer analytics that sits in their internal and back office systems. Second, the number one ask from their businesses to their IT folks today is what we call the needs for speed or the agility. And that's what's driving a lot of the consumption pattern shift in core tech, away from on-prem large capex-driven cycles to a fairly significant as-a-service on-demand environment. And that creates the opportunity for companies like us, because we invested ahead of the curve in helping them adopt and embrace technologies that actually fit in the as a service or an on-demand model. Think of software as a service. Cloud is nothing but compute power as a service. So I think that's really been the number one reason why we've managed to align. And third really is, it's never about cost, but it's always about cost. The ability to find operating efficiencies from their current operating expenditures, and then bringing it all together in a way that they can apply these technologies to transform their customer experience. So I think that strategy has legs. We still feel very good about some of the choices we made over the last few quarters, and I think we continue to adjust and adapt. Technology is changing very rapidly. The level of automation and the uptake that we are seeing from the public cloud platforms, the amount of work that's going into embedding AI and machine learning in almost every aspect of ops and tech are all tailwinds, but at the same time, we need to stay ahead of those by making sure that we're able to actually embrace them and embed them in our service offerings. So I think from that perspective, it's been a fairly strong run, and we just have to be ahead of that anticipation of where the clients would need our help, and that continues to be our focus. And I think from that we do feel good about our market positioning, as well as the fact that our offerings are resonating with the customers.
It's almost similar to one of your larger peers, HCL Tech, when they started to focusing on having changed the business model versus run the business model, where they started to integrate the same, and they saw benefits of that kicking in. So this is going to be important for you, right? To make sure that you blend in the change the business spends, make sure that clients get what they want, rather than just the pure play, bread and butter, run the business spends.
Absolutely, and I think some of that is playing out in our numbers as well. So if you look at the last 18 months, 80+% of our business is actually generated proactively, which means we are helping clients identify the right problems to solve, engaging really early on, helping them design those solutions, and then create those services that help them apply that transformation. So I think in a manner of speaking, our business actually is transformation-led, and then we see a lot of pull-through revenue that comes along with it, whether it happens to be in run or change. So I think early engagement through design thinking, architectural assessments, and building out that whole technology roadmap for end customers is the best way we've discovered to engage, and that's really paying rich dividends because 80% of the business coming proactively is a testimony to that as well.
Nitin, just one quick follow-up. The SaaS companies based out of US are getting stratospheric valuations. Investors are flocking there and businesses are flocking there. Is there an attempt to try and do something similar based out of India as well? Because you have the brain power. The question is whether Indian business can do something which the hub of Silicon Valley is doing very efficiently.
I think SaaS is nothing but a product wrapped in a consumption mode. So are there Indian companies that are focused on the product business? The answer is yes. Are they getting a similar lift on the valuation? And the reason you get a valuation lift is because you create a stickiness annuity revenue stream that is very predictable and very profitable. So that's the reason why you see that lift happening. From our perspective, I think finding a way to give the enterprise customers the transformation needed to actually embrace this shift from on-prem to as a service gives us the biggest opportunity. So while we are building a lot of platforms and capabilities and IP assets, most of what we're trying to do is really use them to embed into our service delivery. So we are not, at least at an Mphasis level, not focused on building products out. But of course, there is a very vibrant product community that is coming out of India in trying to service the global market base. Some of them are established global products already, and some of them continue to be much more focused on at this point in time, at least the emerging market segment. But I think the attempt and the success continues to be visible there as well.
Okay. Nitin, we have time for one last question. While we've been talking about all of these other segments, let's focus also on the BFS segment. Quarter-on-quarter growth, 6.1%. Even if you were to exclude digital risk, you've still done good. 3.7% quarter-on-quarter, 14.4% year-on-year in constant currency. Is this going to be a big revenue churner for you going forward?
It has to be. Yeah. Absolutely has to be, because that's half our business. And I think finding the right congruence of applying some transformation using the deep tech expertise and aligning that to the business verticals and the knowledge that's needed to do that is really what's working for us. I think there's a lot of pressure in core or run the business side of the banking business. So the growth in banking is a direct correlation to how relevant your services are and how the end banks are actually able to leverage those. So I think for us, we've been on the right side of that trend. When we've continued to see a lot of lift both in existing relationships as well as actually new logos. So I think as long as we continue to keep our offerings refreshed, relevant, and ahead of the curve, I actually have no doubts that we'll continue to see growth in that segment.